Hey guys, welcome back to my channel. So in today's video, I'll be sharing with you the top trading mistakes to avoid. Right, so in this video, I'll be sharing with you the trading lessons that I learned in 2022. So this is 1 year worth of mistakes that I made in this year and also the lessons that I learned from it. And by sharing with you these mistakes that I made, hopefully you can learn from them and avoid making the same mistakes that I did. And I believe this can really cut short your learning curve. Right, so we have a quote over here by Warren Buffett. So he mentioned that it's good to learn from your mistakes, but it's better to learn from other people's mistakes. So instead of going through months and years making these mistakes, what you can do is learn from someone who already has this experience and who has already made these mistakes, and learn from their mistakes and take away these key trading lessons. So I did a quick recap of the trading lessons that I learned back in 2021. I have a video over here at the top right of the screen. So these are the summary of the important trading lessons that I learned in 2021. The first is buying too early. The second is buying too late and extended. And the third is buying when the moving averages were sloping down. So as you can see, the first three were with regards to buying. And the fourth one is not cutting losses fast enough. And the last one is not meeting at least the 1:2 risk-reward ratio. So the first three were about entries and the last two were about position management. So for the trading lessons that I learned in 2022 is these four important parts. So the first is progressive exposure. The second is buying, the third is selling, and the fourth is post-analysis. Right, so let's take a deeper look into each of these different categories. So the first one is with regards to progressive exposure. So this year I learned how to size down when trades are not going in my direction. So what I did was I scaled down my trades when I faced losing streaks. And especially during this year where the markets weren't really very good, I had to learn how to size down my trades, especially when I faced losing streaks. Even though generally the markets were not very good throughout the year, there were some periods in time where the market did rally. And this was the periods where I learned how to scale up quickly when things are working and scale down quickly when things are not. Because during these markets, the rallies are very short-lived. So if you're like me and actively trading, these short-term rallies allow you to have opportunities to go long. Right, so I had to learn how to scale up when there was a rally and quickly scale down when the rally has ended. The next thing that I learned about progressive exposure is to only scale up when previous trades are working. So what I meant by this is that even though the markets may rally sometimes, I should only start to scale up when my previous trades have been working. When previous trades are working, this gives me confirmation that I'm aligned with the markets. The next one is to scale down when 2 consecutive trades goes against you. So here we are getting down into the specifics. So let's say I start off at a position size of 5% and I start to scale up when my trades are working. So I scale up from 5% to 10% to let's say 20%. And when my position size is 20% and the trade is a losing trade, then I'll take another 20% position, and if that trade is also a losing trade, then I'll scale back down to 10% and 5% if my trades continue to go against me. The next one is when facing long losing streaks, scale up slower. So I only start to scale up when I have 2 to 3 winning trades. Another thing that I learned when facing long losing streak is to cut back my position size all the way back down to 2.5 to 5% of my total capital. And the reason why I choose 2.5% to 5% is that you can have multiple trades going against you. But at a 2.5% to 5% position size, you can suffer many consecutive losing trades without putting a huge dent on your overall total capital. The next thing that I learned about progressive exposure is to not let your total account go down by more than 10%. Because if your account goes down by more than 10%, it gets harder to claw back those losses. So if you take a look at this table over here, as you go down the table and the losses get larger, it gets harder and harder to claw back those losses. And that is why I have this rule to not let my total account go down by more than 10%. If my total account goes down by more than 10%, I'll start to slow down my trading and also scale back my position size. So that's for progressive exposure. The next one has to do with buying. So for the first mistake and lesson that I learned about buying is that too many stocks bought were overextended. So as you can see, this is an issue that I still continuously face even in this year. So one of the mistakes and lessons that I learned from last year in 2021 was that I bought too many stocks that were overextended. And you can see over here, this is the same mistake that I made for this year. So this is obviously something that I have to pay attention to and work on for the next year. The next one is avoid buying stocks after they have moved up significantly from their bases and only move sideways in 1 month or less. So the first rule of thumb is to avoid buying stocks after they have moved up significantly from their bases. But if these stocks meet your criteria and you believe that they are the next true market leaders, then you should only buy them if they form a base that is 1 month or longer. The next lesson about buying that I learned is to avoid buying stocks with no symmetry in their bases. So what I want to see is that the length of the right side of the base is more or less equal to the length of the left side of the base. But for me, sometimes I still buy stocks whose right side of the base is shorter than the left side of the base. And that is a mistake that I have to avoid making in the future. Another mistake that I made this year is I bought stocks without a proper handle at the top right side of the base. So these stocks will move to the top right side of the base and only move sideways for less than 5 trading sessions, and after that they will break out and I will have bought them. But what I should have done is wait for the stock after the stock has moved up quite significantly at the top right side of the base, and I want to see them move sideways for at least 4 to 5 trading sessions before buying them on the breakout. But at the same time, prices should not tighten up for too long at the top right side of the base. So for example, if the stock moves sideways at the top right side of the base for 2 months or longer, then this is a stock that I should avoid. So the next one is don't buy stocks without a proper handle at the top right side of the base. The next lesson that I learned with regards to buying is to buy only continuation patterns. So when prices are already in a previous uptrend before forming its current base. So a lot of times, even though the base is constructive and I bought from those bases, I realized that prior to that base forming, the stock was in a downtrend. But for my method of trading, I'm not looking to buy at the lowest price, but to buy at the right price, only after prices have shown that it has moved up. So this was an important lesson that I learned. The next one is having multiple fake outs is fine, and it's even constructive as long as they do not form candlesticks with long upper wicks. So if you watch my video on candlesticks over here, you know that candlesticks with long upper wicks indicate that there's a lot of supply in the stock still. So from my own trading experience, I realized that I shouldn't buy breakouts, especially when the last fake out was just recently. So while fake outs are good, as this can shake out wick holders, these fake outs ideally should be not so recent. And the last lesson that I learned about buying is if prices are too far below the breakout point, even though percentage-wise it's still below 5%, I should wait for prices to tighten up more and move closer to the breakout point. So what this means is that at the pivot area, what I want to see is prices forming a pivot area of less than 10%. So anything less than 10% at the pivot area is constructive. So now we are moving on to selling. So with regards to selling, the first lesson I learned is when my stock hit my 2R profits, I should sell half the position and let the other half continue to ride, and sell only when prices close below the 8 moving average. But this only applies in good market environment. So in a tough market condition, whenever prices hit my 2R profit target, I'll sell my whole position. But in a good market environment, for example at the start of a new bull market, when a stock hit my 2R profit target, I should only sell half the position first and let the other half continue to ride. And I should only sell the other half when it closed below a key moving average, for example the 8 moving average. The next one that I learned is if prices are in profit immediately, even if prices move sideways for a couple of trading sessions after that, hold at least half a position, don't sell the full position. So I could still remember the trade. When I bought the stock immediately went up quite a fair bit, but it didn't hit my profit target. But after moving up, it started to move sideways for a while. And being impatient and I thought that the stock was stalling out, I sold all of my position, only to see the stock moving up when I did my post-analysis. So the lesson that I learned over here is that especially when the stock immediately moves up after I bought it, I should hold the stock at least for a while and give it some time to move without choking off my trade. So that's for the selling component. For the post-analysis component, the first lesson that I learned is that even if the stock takes out the pivot low, continue to watch the stock 3 to 4 days after and see whether it can recover. If it does, buy back the stock as the setup is potentially more constructive than the first buy. So the mistake that I did was whenever the stock falls below the pivot low, I'll immediately remove it from my watch list and not pay attention to it. But as I do my post-analysis like 1 week later or 1 month later, I realized that some of the stock form another pivot after that and break out and move up quite significantly. So the lesson that I learned over here is that I should not ignore a stock and take it off my watch list just because it fall below the pivot low. I should still keep it in my watch list, maybe not in the high priority watch list, but still at least keep them on my watch list first. The next lesson that I learned is when reviewing past trades, look at the chart and see whether you are able to identify the entry day. If you are able to identify your entry day correctly, then it indicates that it's probably a good entry. So as we know, hindsight is always 20/20. So when you do post-analysis and review your past trades, after seeing the direction of where your stock goes after you bought it, if the entry point you identified in your post-analysis is the same as the entry point that you entered the stock at, then for me personally, I will identify that that is a good entry. The next lesson that I learned is to monitor at the end of every week whether breakouts are working and adjust tactics accordingly. So if you guys have been following me for quite a while now, you know that my trading style revolves around buying on the breakouts. So this is a very important lesson that I learned because during these tough market conditions, a lot of the standard breakouts haven't been really working. So what I want to do is I want to look for lower entries and see whether they are working. And if they are working, then I should adjust my tactics accordingly to match the prevailing market conditions. So a very important point to take note over here, I'm not changing my strategy. I'm still looking for contraction in price and volume. All I'm doing is I'm looking for lower entries. So I'm adjusting my tactics, not changing my strategy. And what I learned to do is to monitor the previous 1 to 2 weeks and see how the trades and my buy alert stocks have been performing. So if in the past 1 to 2 weeks, if the stocks that I buy on the breakout aren't working and aren't falling through, and the stocks that I did not buy but are on my watch list, and they break out but they are not falling through, then this indicates that the normal level of breakouts aren't working. Then what I will do moving forward is to adjust my strategy and only look for lower entries. So this is a very important lesson that I learned, that I should not bulldoze my way through a tough market condition, because at the end of the day, the market is always right. So what I learned to do is bend alongside the market. So if the markets are telling me that standard breakouts are not working and lower entries are working, then what I will do is I will align myself with the markets and start to look for lower entries and only buy stocks coming out from lower entries. So that's a wrap up of the main trading lessons that I learned in 2022. Hopefully you have learned something from this video. If you did, smash that like button because it really helps the channel grow and allow me to produce more content such as this. And if you are new to this channel, subscribe to my channel because each week I'll release new videos about investing, trading and the stock market. I'll see you in the other videos to your financial success.